Greetings, market rebels. Welcome to this week's macro measure. It's Sunday, October 29th, 2023. It's a little in front of 3 p.m. here on the East Coast. I'm going to get things rolling. I'm Wayne, and as many of you know, and here is our trusty disclaimer for Market Rebellion. And here is our trusty intellectual property rights notice. I'm going to flash this week's stream now after you've had a look at the property rights notice. And this is this week's coverage. And then after a few seconds, I'll flash last week's. And this way, if anyone wants a chance to just take a screen capture or whatnot, they can to kind of follow along with the discussion. And here's last week's. So I think that should be pretty good for now. Let me just get switched over to the proper screen. So please bear with me. Stop our share. We will reposition things so I can cover them properly. And I think what I'm going to do is to leave that there and then bring up the, well, actually that didn't move where I wanted it to. So let me bring up my other screen. Oh, come on. Well, I'm not sure why. There it is. I just got it to screen 4 for some reason. I'm not sure why, but it seems like Zoom picks it up differently a lot. No big deal. But you should be at this point seeing the yields. So that's really where we're going to get started with after some remarks. I'll move this over and then I'll move it back out of the way for us. But let's do the quick review like we typically do. This is a lot of what we had coming into this week. So those Mag 7 that we talked about and the Teflon sectors, which we've talked about, those are really XLK, XLC, SMH, XLE, of course, but as I typically note, right, XLE is sort of its own thing to a large extent. But you could see the XLK and you could see the XLC both really started to give it up. We'll talk about SMH maybe here, and then in then in sector situation, I'll definitely cover SMH. But you could see that from the week before that they were losing their luster. And I think it was what we were really looking for to really say, okay, this market can finally get that stronger selling phase than what we'd seen. Maybe you finally get the whoosh lower. Maybe we still do. So we'll see. We had noted that the SPYs closed near a critical area. We said that could be argued two ways. And will they just crack it, right? And then use maybe the EPS for a takedown or a jam job, depending on how EPS played out. Well, it seems like they were near that area. They cracked that critical area and they used the EPS results and I guess commentary they didn't like on the conference calls to really take the market down. We were fortunately at DEFCON 1 last week. We've been very near DEFCON 1 for several weeks. So again, it's good to just check with that what that intermediate term trend is, short term trend, and be prepared. I think we did say that we thought that stocks were on the precipice in the back half of October, which is not typically very kind to stocks. We'll show that when we get to the tabs very shortly. And then we noted that if stocks were to plunge into risk off, that would bring them more in line with the way we think about the economic prospects, not necessarily the right way, but that's basically been our take for a while, that this market was detached from the underlying economic realities. But that's not really something I would say that's rare. I think that happens a lot, in my opinion, but it takes a very long time sometimes for that to be recognized, for the market to then begin realizing that it got it wrong. And I do think they got it wrong. I do think the rally from the October lows of 22 into the late July of this year was not really well founded and ran too far. But again, you had to trade it. We traded it that way up, right? We really tried to go with it as much as we could, even though we just didn't think it was, let's say, a prudent way to go for long-term investing. But that's the difference, I guess, between trading and investing. We did say expect more volatility. We did say that historically, there's been a lot of signs of bottoming in late Oct, and we were wondering if we would have to see a sell-off, right, which we really did get last week first, or was it already squeeze time because they were going to be able to use the kind of gravity defying mag 7 along with the EPS to start a relief rally or a squeeze. And so they went the other way with it, right? They went the negative way. So we did say the market was already oversold. So we said you should keep your rolling discipline knob turned up to 11, because when you get into this degree of oversoldness, I think you really have to just keep taking it and protecting it, taking it and protecting it, because I would say that a bogus news headline that will turn out to be a complete piece of propaganda or worse can hit the market at any time. So every time I think you get a nice drop, you should really at least consider a good roll, the way you like to roll. So the way things played out with the outcome would be that we popped from Monday into Tuesday early. Yet again, Friday was forgotten, the kind of ugly Fridayness that we had, and then the war escalation relief probably helped that, right? We would expect. So it is what it is, but that's been happening quite a bit. We did see really a docile week from TNX, DXY, and the VIX, I think, considering what happened. It seems to me that EPS and the conference calls just together sort of help shift the price of stocks, and that started to shift the sentiment in a larger way, it seems. So I would say that was basically the bulls that we've been saying, maybe even premature bulls, became maybe even more nervous, and that jump the gun anxiety we've been talking about continued to maybe spread, and maybe it's permeated, further across the market and in a more significant way. We did see more heat coming into the Teflon sectors and the Mag 7, no doubt about it. And now, right, that's the thing that's one of my big questions is, are they set to see more selling? Remember, Apple's reporting this week. The FOMC will be going down midweek. So you've got some really big stuff happening. That critical area that we talked about was lost in the SPY. And again, that was a reminder on that. So I think right now what we can do is more or less do a tabs check. And I'm going to leave us right on this screen because I've got it set up that way. But we'll go through here. Let's just take a look at some of these things that we typically have checked out recently. And you'll see that we're just still kind of, we're off the highs a little bit, but if we look at this data, we're still back to where we have been, right? We haven't gotten higher to where you've got to go back even further to find a comparison. So for now, markets are respecting these kind of tops from about, I guess you would say, about roughly 15 years ago. So that's really been the case across all of the, I guess, the yield term structure. Let's see, let's do the 10-year, which is really our kind of strange that's why am I not getting US 10? Why am I not getting US 10? Did it not come up? Maybe it likes to do it this way. Well, regardless, I'm switching to there. We'll go to the 20 just to get something a little bit longer term. And it's pretty consistent. It's just about back towards these same levels in terms of years, right? In terms of a comparison. So that just gives you an idea where you are. They haven't really allowed this thing to go any further. It's kind of hesitating up here. So that is one of the big unknowns. But obviously, I'm, again, advocating that folks keep their eyes on the TNX, other ones if you want. But I would definitely keep your eyes on this, because if this continues up through what Powell has to say and what happens, which that would really probably not be good and probably would bring about even more selling. because I think they're thinking for sure that nothing happens here, and that there may be maybe a little bone thrown out in terms of we're looking at maybe pausing for longer rather than being ready to raise rates again. But you could see that through January, the probabilities still favor staying here or going up. You really have to go all the way out. This is how where the probabilities still lean, right? So even through March, it's more of the market believes we're most likely to either stay still or go higher. You have to go all the way out, I think, to June, and I'm wrong because it may have shifted. Yeah, I think it did shift. So you have to go all the way out to May now. So by May, the expectation is stay here or go lower. That's where things flip. So that's what they're expecting at this point. So that's still, in my book, that's about 1 year of rates going higher and staying higher than the bulls were arguing would be the case in the spring of this year. That's my recollection. So I think that's why there's this, not only that's the only reason why, but that's the reason why I think a lot of these people are second guessing themselves and becoming, anxiety riddled, apprehensive, whatever you want to call it. Here's something I think we have to keep in mind though this week. This is the AAII that we typically look at, and you can see that the bullishness has plunged and bearishness has spiked back up. So we're about as high as we've been, or depending on how you want to look at it, or as low as we've been over here in about 1 month's time, roughly speaking, just give or take. You could see that it doesn't get all that much lower in terms of bullishness that frequently, going back over the past, say, 6 months or so. It doesn't often get too much more bearish than this. You could see that as well. In fact, this is the most bearish. So when you see the most bearish number up there, and one of your lower bullish readings, that should help you out in terms of your rolling discipline. Why should I continue every time the market drops another 1%? Why should I probably think about getting rolls in? Because this is where we are, and yes, we could have some sort of a real crash. You can't rule that out. It's just that even in a crash, you would still do extremely well by being a disciplined roller. You may not hit the grand slam of grand slams if that's what you're going after, but you would still fare very well. On the flip side, when there's a potential for a crash, the market, I would say, far more than not finds a way to rally. And again, it could even be from a bogus headline. So it's very tough to play the downside. That's why when you get to times like this, especially, that's why I am more, if you give me a bull market that's stupid, I'll take that every time over a bear market that makes sense. Because even though myself, I've been an economic bear ever since the rally, even before, I've been an economic bear since the end of 2021. So on that side of it, but more of a bull when they put the bottom in. You knew there was some, I shouldn't say you knew, but you had a good sense that there was a tradable low there that they could do something with. You never know how far they're going to take it at the time, and you look how far they jammed up. I mean, like we always say, the Qs managed to rally over 50% off the lows in about 9 months. Remarkable, right? Plus, right, you're in extreme fear right now. So here's the timeline. Could you get lower? Yes, you can. You can get lower for sure. But are you getting down there? Yeah, you are. So I think, again, you've got to be on your best behavior when it comes to rolling. This is the one, the MMTH, the percentage of stocks above the 200, that we were waiting. When it was way up here, we said, yeah, this could really have more to it. And I'd say that this could still have more to it, but you also have to acknowledge at this point, at this very moment, we are much closer to these lows that preceded or helped mark the market lows than we are to the highs. So the market's definitely getting bombed out, which is a popular way of describing it these days. MMTW. There's your percentage of stocks above the 20 SMA. And look, you're getting close there to the lowest, some of the lower lows you've seen. You're within striking distance. So you have to keep that in mind, I think, because in the face of all things logical, reasonable, rational, these guys are the masters of creating something from nothing, right? And turning something around in a big way when it makes absolutely no sense to anyone. I often wonder about, why do stocks have to stop going down and then instantly start going back up rather than just stop going down and tread water for a while? Like, it seems like in days gone by that happens, and it doesn't seem to happen anymore. There's such an, ever since I think the online trading mania of the 90s, it's been, you got to get right back in. Let's get right back in. That's, that mentality to me is, and again, it might just be my own 30-year bias, not really having seen historical market cycles further back personally. But look, here's your percent of stocks above the 50. You're getting there. You've got to acknowledge that you're getting there. And if you're, a lot of what we try to do, right, is play the probabilities and what's more likely. And we try to do this prep work to not be caught off guard. And so we have to acknowledge, even if we still don't think that things are rosy and the market does probably have more downside to really come into line with the economy, that these guys are close to levels at which they've been able to support and hold the market on several different types of looks or views. And notice too that this third year of the cycle, notice that this October was pretty rough. The back half of it certainly has been rough. And that's really kind of in line with what you see. There's your red line. There's the black line, right? And so you kind of fall into October. But note that in many cases, really in all, they find a way to start lifting it, stabilizing things typically in November, and then it's off to the bonus races, right, for December, largely, with a little bit of a spine or wrinkle in the middle where they hesitate. So just keep that in mind, because don't be surprised if the slimmest of information brings folks on to talk about how this represents a tremendous buying opportunity because of how discounted stocks have recently become due to all this selling. So that will be probably something that you begin to hear if they start turning the market, which will add to the upside fund, the squeezing that would, again, come just in time to make sure these guys get some kind of a bonus. It's just fascinating, but it is what it is. Remember, we flashed this last week or the week before. I can't even remember, to be honest, because it's been, the last few weeks for me have been a real whirlwind. But remember that the bottom line is that when the Fed begins to cut, kind of, you get that the market gets the sense that maybe cuts are on the way, and then they begin to cut. When they do that, the market is down about 10% a year afterwards. So just keep that in mind, because that will be the argument, right? That if the Fed does make a signal here, you certainly could have a relief rally. We know that if they really feel like the Fed is going to acknowledge that maybe they over tightened and they just raised things too quickly, or whatever the case may be, they are going to try to make the most out of that, of course. So you've got to be prepared for that. So that's where we can end on tabs. So let's just switch over to the charts, and I will switch from that to my main screen for charting. Share screen number 3. There we go. So yeah, so we're back to where we usually start sector situation, but it's probably worth leaving up here because what happened, aside from XLK and XLC, a really strong sector in XLE, right? Despite what's happening around the world, unfortunately, that also got hammered down pretty hard this week. Also, I think another notable thing is that the financials took out the lows, right, from those lows there from June. It's hard to see. I'll try to do more of this in the sector situation, but that's really a bad sign. Remember, I'm big on financials. I'm big on transports. And if you notice the transport break that we noticed a while back, this market got pulled down ultimately, and maybe even will be pulled down even more. And I think a big part of that was being signaled by this XTN. So I think it gave me more confidence watching this to continue to report in these videos that I think that the economic aspects that I'm following through research that we uncover, Ryan, Greg, myself, occasionally my son Pearson, that the information we were finding is probably, despite the fact that it isn't covered as heavily as anything they can muster bullishly, that yeah, that was probably the real deal. Transports were telling you, I think that it was the real deal, and that again gave me confidence. And they're clearly oversold at 24 on the daily RSI. XLF is clearly oversold at 28, right? So you've got to take note of this. The market, you can see that everything's either oversold or very close to oversold status. It doesn't mean it can't fall. I'm just saying you're getting to where you really have to be disciplined about things. I mean, if we get a really serious whoosh lower, let me just get rid of that. Let me get rid of this. Oh, there's my wife. Oh, well, let me get to the right chart here. Oh, I thought the charts were up. So my bad, my apologies for that. But anyway, this is, oh, this is Apple. I thought I was, wow, I don't know what I did. I must have typed the wrong symbol in the wrong chart. But what I was really getting at is that these big sectors and were really getting rocked. We may as well look at SMH since I was on that subject. And we've been waiting for this SMH gap to possibly get filled with everyone else that's waiting for it to get filled, which we made note of, right? There's no surprise there. But this is why, right? If this cracks this 200, I think it'll come close to getting filled at that point. If you get the crack in the NVDA, which looks like it potentially could crack, right? If that cracks, well, it's hard. My charts, I've got to do something for these videos that's different, but you can see that this is almost like a neckline here. So again, when you have such a prominent pattern and such a prominent stock, you've got to be ready, because breakdowns can be you can get a false breakdown here easy, right? They would potentially lure a lot of people in. Oh my gosh, this stock that ran insanely is breaking below the neckline. Everybody knows about it, and then everyone sees the gap. Everybody thinks they start ordering. I should say, start making reservations for the finest restaurants and ordering motorboats with 3 propellers on them, things like that. But you just can't do that because you just don't know, right? You don't know. You really cannot know if it will be false or a legitimate breakdown. So again, I'm a big advocate of the quick trim that we cover. I've been saying that. People get tired of me saying that, but for people that are new, I think it could still be helpful. But that's the kind of thing that could happen. So look, if this thing cracks, then that's the sign, I think, that, and it's really getting lamped. That's the sign on its way maybe to the 200 for starters. That's a long ways to go. That's $55 roughly down from here. That's going to be nearly, not quite, but nearly 15%. So that's from here, right? That would be another serious drop. And if that were to happen, you would probably say that the market has gone into whoosh mode. We do get a real serious selling phase that probably gets very overdone before it ends. And if you look at this rectangle that we're in here and you say, okay, 503, let's talk about the low being, we'll round it off to 400. If you were to drop 103 points in 100% of the height of the, let's say, the rectangle from high to low, really rough, right? But that would be 390. That would be 297. 297. And that's really a serious drop. The high here is on that gap is only 306. But if this drop were to occur, you get in within striking distance of that gap. So if you do get a breakdown from this head and shoulders that's in there, again, very tricky one. I mean, it couldn't really be in a much higher profile stock of the moment for 2023. That's something you got to be, I think, wary of. But if it does fulfill its destiny, let's say, that's obviously lights out for the market more than likely. If this stock comes under that kind of selling pressure, that means you probably got washed out. And what that also means is that the third year of the presidential cycle, which really tracked well, because remember, it really expected, if you will, it really expected this late October weakness. We've noted that, and it's done a fine job, I would say, this year by keeping. We've probably gotten a little bit of a bonus from just keeping an eye on that for sure through trying to navigate through the market this year. And I do think it's paid off. I really do. But that would be the departure, right? Because if the market really goes into, let's say, crash or just really very serious corrective activity phase, and you get the whoosh lower, you get the real cascade selling that's been missing, that we haven't seen, where it's just like, no, it's over. And it just like you get a phase like this or something along those lines, which this could sort of metastasize into. Then I think that's where you'll get this probably tradable low, because there's hope will always spring eternal until no one wants to hear about online trading anymore. I guess that's what it will take to really break this sort of obsessive got to rush in and buy stocks, go in the FOMO factor, right? Buy the dip. That usually that would need to be crushed in a really severe way, and we just haven't seen that. But this come on, guys, this SPY chart here, and I know it's a little messy and big and tough to see, and I'll magnify it shortly. But this is the line we've been waiting on. I think some folks have expected the line to be, they have their line in a different place. I think I mentioned I felt pretty good about this line, and the fact that we broke below it, came up and tried to get back above it, and then fell from there. And that was something we were watching for. And so to me, that line vindicated itself. It proved its worth, right, for us, where we thought that was really when the trend was breaking for real. And now we could have trend break follow through from here. The only thing is, look at SPY. Now that I've magnified things, you're outside of the lower Bollinger, right? That's the green dotted line, significantly outside already of the lower Bollinger. Now, I do kind of take off points for how significant this is based on the fact that the Bollinger Bands are not that wide. So it's not really the kind of Bollinger Band excursion, in my experience, that really gets me really jazzed up. For example, look how much wider the bands are back here near this low. Look how wide the bands are near these lows. The bands are much wider, and I think you could get a real pops. And you did get one here. This one was a false one, but you did get a real big pop after that. I would say it would take a little bit more. You'd have to, in other words, fall far further below these bands, this lower band, because of the narrowness of the bands, to get a real super oversold condition, super stretched condition. And so we were talking about levels and cocktail hour, and I was on my laptop, and it was very hard for me to get really good levels, but I did come back home from having to travel. And to me, now that I'm on my normal setup, I think we can't fail to mention this 408. Now, the 408, just like the 432-ish, give or take, that we've talked about, that to me, the 408 this has been a big level going back. So we can't discount that. We got really close to it already. So 408 has been a number that's mattered many times in the last few years. So that's your next sort of just level that does not involve a fib in my mind, not an obvious fib anyway. The level at 404, that is very close to the 50% retracement of the rally that ran from the low in mid-oct all the way through July practically of this year. So I think, to me, I usually look at it like when you fall below on a major move like this, when you fall below a fib level, there's a pretty good chance you're headed to the next fib level to get with at least somewhat close to it. So could you say that the low of let's see, what is the low that day? Wasn't it 409? Yeah. Is 409 close enough to 403? It's only 1.5% away, right? So you could say, yeah, it got pretty close, but just visually, I would expect it to get a little closer. So I'm going to stick with, I think they're, and this could be interesting too, because let's say that there's a little more downside and you get down to this fib, maybe they overshoot it just a hair, right, to really get people freaked. Then maybe, right, there could be that squaring up in front of the Fed. You have to think, and that could be legitimate in the sense that it won't all be the gang rigging things to go back up, because if you've done very well as a bear and you've cracked below the 200 by the degree that we have, and you've cracked below the lower Bollinger, and you've cracked the trend, and you were right to be gutsy and stay short through the EPS and all these things that it required for you to be this outstanding bear side trader recently, you have to admit that that there's the potential for maybe Apple or maybe FOMC or both that could create a short-term relief rally or squeeze, probably both, right? A little bit of both. So that's what I think you have to watch out for. That's why I think this is so hard. Everyone knows, it's been with Market Rebellion for many years, that Ryan and I guess Greg too, really are not fans of trading through earnings season. And I hate Fed events because they get in the way of what I think is more natural technical movement that we can feast on a lot more easily without those wild cards. But just because people were asking on Cocktail, and I'm thinking of you, Tomoko, and that's okay. But because we were getting a little bit of requests for that, I think 404 is the next level near that 50%. It's the next kind of big one. And then the next one without a fib too below there, I'd put that at about 397-ish. I think there's something there. I remember that. The reason I'm not a stickler for giving you an exact penny or something like that is because this is really not something that these kind of tools to me are not the kind of things that produce typically very consistently produce exact penny projections. I'll throw the exact penny number out there and just, it comes to this, but I don't expect it to really trade exactly to there. I mean, I think there's a much greater chances that it bottoms just in front of it or a little bit below it if it's going to respect the level, if you get what I'm saying. So I wouldn't get hung up on the 396.49. More or less like the 397 area to me is pretty big. That would be a next big non-fib level. And then the next one really below there is your 390, roughly speaking. I think that 61.8 retracement, if you're a bull, you really don't want to see this get violated, right? Because if that gets violated, close below, and then invites more selling, usually, right, the deeper the retracement, the lack, going forward, the lack in faith of really believing in this whole move as a wave one increases. In other words, you lose confidence in this being maybe the first part of a real bull market, and you start thinking more or less like it's really was a deceptive move inside of a longer term bear, basically the correction of inside of a bear. So keep that in mind. But so those are just because they were requested, I'm sticking with 408. I can't shrug that level off. I remember that being so big. It was kind of like 408.73 sticks in my mind, where we had that through 22 many times, I think, had it earlier this year. Then 404, then, which I know is close, but look, you can't disrespect the fibs. Too many people, I think, use them. So then your next one's about 397-ish, roughly speaking, and then 390. And then anyone that needs levels beyond that, if we really do go into the cascade, of course, we'll put those out through the services, or If we haven't, because we're so swamped, whatever service you're in, and if you've got those requests and we're trading SPY, we'll be happy to provide levels through the forums and then disseminate them to everyone. So that's really the look there. I almost forgot to mention this because I have so many things swirling in my mind in terms of what I want to mention. But that's not that. It's this one here. What's also at risk here, in my mind, is that this market could be sealing. The way that I look at things, this market could start to seal its own fate, technically, for the next few months, if it doesn't support and start to rally before Halloween concludes. I think that this is, and let me try to reposition this and make it a little bit larger. Thinkorswim just does not cooperate with me because I've probably overdone it. It's probably honestly my fault. I really can't blame Thinkorswim for everything. I just have too many things running. And what I'm getting at is this lower high here to here. And if you start to say that this thing's really going to come undone, that probably means for a while, for the next several months, you would expect maybe if it happens very quickly, no. If it happens a little bit more slowly, yes. It could be several months of not wonderful action. So I think they're really at risk of opening the door to that with not anything less than a strong reversal finish from here. I think the market's already, its goose is already cooked for the next few months if they cannot lift this market up pretty strongly from here. I can't tell you exactly what I would need to see, but it would probably require the market to at least be above, well, at least be near 430. And if you think about it, could that happen? Could you rise 20 points really quickly in the SPY? Wouldn't that be a 5% move? Yeah. I mean, remember though, look, these guys are capable of these things on a monthly basis. So the other thing I would like to note for you is that if October instead finishes really poorly and we have an ugly candle that really allows the market to get walloped much more than it has so far. I think it's actually hung on quite well to this point. But remember that usually, and you can see that even in here, usually after you've had one thing or the other that's been very strong, they usually have a little revert. The next month is usually, or shortly thereafter is usually there's a counter move or reversal, especially to the upside, right? A couple ugly bear candles, boom, they jam it right back up. A couple of ugly bear candles, boom, they jam it right back up. You get the idea. Ugly bear candle, boom, right back up. So that's the other thing that you have to keep in mind. If this there's a panic on the first couple of days of that are left here in OCT to trade, and you get that really ugly candle, you got to remember that you'll be super oversold, bombed out, whatever you want to call it, and the gang is great at manufacturing stuff when they need to. And they probably, right, it becomes almost like feeds on itself type of thing. So the momentum kicks in that way. Momentum traders see that, right? They pile in, people are getting squeezed more and more. So you got to be careful. Again, discipline. You know, get your trims and rolls done when it becomes extreme and you've made made a real windfall. You know, close it out and set an alert to get back in if you have to. But let's cover the Qs. I think Tomoko may have been asking about the Qs as well in cocktail hour, and so I went and looked at it, and I want to make sure that I cover all these. I've been focusing on charts and on the macro stuff to try to, I think they're both important so that you understand the context that you're operating within. But we used to probably, the idea was to do more charting here in these videos, but I think it's been important to mention these factors. Not everyone agrees. Probably a lot of people don't agree with that, which I guess it's just a philosophical difference between myself and a lot of people, but I think it's important. And I almost can't help but to do it. But I looked at this and you could see that really the Qs have held up the best. And that's of course because of XLC, XLK, SMH, and the MAG 7. And those, right, those are finally giving way. Now you could see they too are below the lower Bollinger. They too are checking in with an RSI barely above 30 at this point. So remember, if NVIDIA starts to get rocked or another name starts to get rocked, and maybe Apple can't do it all, we'll see. But this is the gap that exists in the Qs, right? So that is a high of about 333. So that would be another, what would that be? Almost 4% more, not quite. So yeah, there's your 200, right? That puts you within striking distance of the gap closure. Remember, the SPYs are well below the 200. So yeah, for this to really kind of catch down, it would be quite a move. So I don't know if, I know that a lot of those players that are probably having a little bit of buyer's remorse for jumping the gun on the new emerging bull, and basically believing the hype, I think a little too soon. They are probably reluctant to part ways with some of their core holdings, which are probably the same core holdings that so many other people have, which you can guess what they are: Mag 7 and others, but mainly a lot of the Mag 7. So that, to me, that's what's been able to hold this up. And this is what I think would happen, right? This could finally close, and it would be, if that were to happen, you were to get this closure on this, that would be really overdone at that point. You'd be very oversold. Not that in a market crash that matters, but in most like serious corrections, you'd be getting down there. So the next numbers for me, next levels are about 337 and about 333, just on that one. If we do continue to get downside, remember, if we do get upside on some of these things, remember that a lot of the SMAs are rolling over and will be declining. And so usually with a declining SMA, that's something you look for. And a lot of times stocks will get kind of caught near there, not necessarily directly on the declining SMA, but it'll be the upward surge can be erupted. I'm sorry, abruptly turned around at those levels. I didn't mean erupted. So if that were to happen, you've got to keep your mind on some of those SMAs, because yeah, it'll pierce through like here and then right back down. Pierce up to the 100 week right there, and then you get back down. Hesitate in front of them for a month and a half before finally being able to break through. Again, that's kind of like what I call the base camp concept. But yeah, so anyway, these levels are big. Lower high is potentially big. If you're a bull, you really don't want to see a lower high, and then this act like we've seen what happens when you make lower highs, and then you're really getting walloped. And I think the potential's there for that, but I'm not pounding the table on it. I just want to be clear, but I just want to note that given all things that are out there swirling around, that's where things are. So let's see here. So here is a bigger picture view on the weekly on the IWM. You could see I've got this rectangle that I think I've had that for a little while, between really 199-ish and 163. So that's about 26 points. 26 points below 163 would put you at about 137, I believe. So that would be 137 would be way down here. I'll put my cursor there. And so the market did respect that level. It's very close to, like, I would say, areas that were respected because of where the post gap high was, and then this kind of respect over and over and over again for several weeks. So that is sort of the vanilla projection if this breakdown of this rectangle were to occur, and that's just one aspect. So this is one reason I like to look at patterns, but I like to look at a lot of other things. That's why it takes me ideally it takes me a long time to do something, because I like to just look at a lot of different aspects and what a lot of different things are saying. But 32 on RSI. So, if this were to break down soon, clearly this is the weekly too. So this would be breaking down from a very near oversold level. You're very close to being oversold. So you'd be breaking down from an oversold level. And then if you get more of a retracement on this whole move, right, the whole manic move that we saw, that is going to probably take you to the next level. We think be your 61.8, and that's going to give you that 152, 153 type number. So that would be, you know, quite a bit down, almost another 10 points from here in IWM. And I don't think that's out of the realm of possibility. It would be bad. I think this would happen, I think, with the very high probability or likelihood if Powell comes off as not even really changing his tune all that much. I think if they read that and like, man, the Fed is really being hard-assed about this stuff, that could, these companies are not deep-pocketed companies. These are smaller companies that could really create a lot of mayhem, I think, in this sector. And if you look at sort of this 244-ish number, you look at the 163 number, you're looking at about, I think that would be, yeah, about 81 points. I'm just ballparking something real quick here. That would put you, believe it or not, like, this is a little scary, but the projection, one form of projection actually puts you down to about 110, which is right near there, right on the horizontal line that I've got for my pointer, right near there. So that's epic. You know, that you don't see that. I mean, remember, the reason why things got rocked in a big way there was due to the pandemic, but this would be a real route. I mean, this would be a real route on the monthly. So, but those are the numbers I think you're looking at. I mean, if we go into the daily chart, let's go to a good daily, right? Well, you can see how this is way below the Bollinger right now, and you're at 29 on the RSI. So the market's, I think, doing its job in terms of factoring in how this will hurt these companies. And you could see that we've bottomed around here and many times. And remember that these guys love to exceed these key visual lows and things like that, draw people in. And then, of course, from that point on, it's slit throats, right? They get that squeeze going, and it's merciless. So another reason why you have to be doing your DDA in this market, because if you're trading IWM and it is a great trader, be very careful, right? We can't rule out. We think there really could be a serious breakdown here, but remember, timing is everything, and it could. A lot of times when you get this far out of the Bollingers, they're going to put a little something together before another like round of failure and rollover, right? And you can see the bands are starting to widen here, and so that too would make it possible for this to get well within the Bollinger, and then have a lot, because the bands are widening, have even more room to go before it finally falls and gets outside of the Bollingers again. So just keep that in mind, because it might, I can't say that they won't resuscitate this. I'm sorry, that they won't annihilate this further from here, but I do know that these are the conditions that precede relief rallies typically. So that's noted on the this week's stream. So just keep that in mind. And I do think that, I do think your next level, just to be really clear about it, I do think you really are looking at that. You could, there's other levels that Ryan's going to have in here. I mean, I think you're probably, obviously 158 is the level, right? We should probably just even drop that in there while we're here, because I've had a lot on my plate, and I'm trying to get this stuff out for everyone before it gets too late, and it's already 22:04 here on the East Coast. So that's why I didn't have time to unfortunately do all this. I still have to do sector situation for everyone. But yeah, I think that's this 158-ish. These are the next couple of biggies, and then 152-ish to me is, because of where that fib is big. So those are your next two there, and I think that's going to leave us with diamonds only. So let's cover the diamonds. I don't think a lot of folks trade this. I know some do, but a lot of folks prefer to trade the IWM, the Qs, and the SPYs. I'd say more so than the diamonds. I personally am on board with the folks that don't like to trade this as much. I like to trade the Qs and the IWM and SPYs in kind of in that order. But anyway, I would say, look, the next level is here to me. If this does continue to descend, is going to be 319-ish and 318-ish and then 302. And that's there's big space between there. The only reason I'm not really pounding the table on this being even more oversold, even though I would say, look, this is definitely oversold, is just because the bands are narrow. But if you go off of your RSI, you're at about 29 if we round it. So that's pretty overdone. Now, I haven't done this on the other ones, but this is something, if you're new, this has always helped me out, just to kind of put things in perspective. And if you go and look and put your cursor on that low where we are in RSI, you can see that there's not many lows that exceed this across the last several years. And so, right, what happened after those lows? Well, you could see they had that happen, in early Oct, and they put a decent rally together. Here, they had that happen, and they put a kind of a decent rally together. Down in here, right, this was preceding the bottoming process. That's like something to keep an eye on. This one is right near a low. These are right near what turned out to be tradable little trades. So that were working, right? This turned out to be a trade that you could have. And I'm not a big counter trend trader, but of course, yes, I'll do counter trend trades, but I just keep them on short leashes, right? And I'm really even more of a disciplined manager in rolling, because I know that I'm going against the dominant or primary trend at the moment, and that's usually shorter lived than you expect. So that's again why I'm more like, okay, I'm not going to overstay my welcome because I'm going counter trend. Another one back here, right? I could do this a lot. So does it work without fail? Of course it doesn't. But you do have to recognize that if you get a really rough start to this week, you're going to be near some of the most oversold levels on RSI, and be even really stretched beyond your Bollingers by a great degree that you don't see all that often. And when you do see it, it doesn't last for too long. So that's what I think you have to keep your eyes on. So we probably need to start wrapping up. My current assessment would be, you've got to keep your eyes on all the things we have been. Sounds like a broken record. TNX, with the market bombed out, got to keep your eyes on TNX, DXY, and the VIX. To me, I would be surprised if this ends without the VIX at least chirping a little bit more. The VIX, to me, not spiking up towards 30 is sort of a missing element, but I feel like I'm starting to turn into the old timers that I listened to, which were kind enough to share thoughts with me. And they shared things that were valuable with me when I was just getting into charting in a bigger way. And they were very helpful. And to this day, I thank them for what they did share with me. And I feel like now, because the VIX typically would do something like that, I feel like I'm at that stage where I would tell like someone younger, yeah, wait for the VIX to get up in near the 30s. That's when you're kind of on the hourglass in terms of how much longer the selling is typically going to last. But it's been pretty ugly, and the VIX still hasn't made its move above the mid-20s. So, I'm wondering if that will still matter, kind of like something I believed in for a long time. Will it matter again? I don't know. But just thought I'd mention that. Still hasn't done that. I would still look for it, but again, I'm starting to wonder if my bias, my own personal bias, is making me miss the signs that the VIX is no longer as relevant as it once was. Again, it probably doesn't get much bigger than Apple EPS and the FOMC, kind of like right within short order. If I'm not mistaken, the the Fed will do their thing on Wednesday, and I believe Apple does their thing on Thursday. So this could be very interesting. I would still be at DEFCON 1. I think you can't, we already talked about this, but I don't think you can rule out the relief rally you from these levels. And if you want to understand why, the gang, the market maker part of the gang, right? They've been buying a lot of stuff that's been getting lamped, right? So what do they want to do? They would like nothing better than to have some kind of a quick relief rally that lets them take some of what they've been buying and then sell it back up here so they can absorb more selling right on the way down. So whatever they haven't laid off to someone else. So if the plan is to drop one more time or even more so than that, I would still think they want to offload at higher prices before they let that next drop happen. To me, again, the market is rife with signs of perceived relief rallies. I can't remember more stuff swirling around the world and the markets than at this time in my 30 years of being in the market as a trader. I don't have it that quantified. I'm just saying, to me, this strikes me as one of those times where it's almost overwhelming how much is out there. I still would expect to see more volatility. I still think you could see signs of bottoming soon. We have to mention the third-year script or the presidential cycle has really tracked well, even to this point, with that really ugly finish that we're seeing to this point with just a few sessions left, right, in October. So remember the dollar and yields that they could continue to power. If the war, it would be surprising to me if things get worse and people don't start buying bonds. That would, of course, bring the yields down, or at least keep them level. I would be surprised at that, but that could be, if you don't see the yields popping, that could be the reason why, even though you think maybe they should. It's just because a lot of people are finally saying, I'm moving some of this stock, converting that into cash and then getting into treasuries with it. Let's see, what else do we have? Yeah, so this is when we typically see the conclusion to the worst of the worst. And then November is usually a stabilization month, and that gets them set up for the end of year rally for bonuses. And of course, how the new year propaganda blitz will kick in with, yeah, it was a tough year, but next year's looking really good without fail practically. I still can't buy what these perma bulls are selling. I don't care about what they floated as a GDP number. I've seen too many revisions after the fact of all these numbers that are supposedly very good. And to me, it's probably loaded with gimmicks. Without even looking at it, I'm saying that. I know that sounds a little reckless, but I'm just playing 30 years worth of observation probabilities. That's the best I've got on that. In other words, the wall of worry is in place still, right? So if you want to say, well, the sentiment's gotten awful, it doesn't look good right now, I think they could use that, right? A lot of people might have to be drug along at this point. So that kind of ugliness right now could be used to help grease the skids for the end of year rally, is what I'm getting at. Could the bulls, so that wall of worry could help. That's what I'm getting at with, could the bulls help once the final seller has sold? So when the selling's done and things look horrible in a lot of people's minds, according to AAII right now, maybe it gets worse too if we have a rough start to the week or a rough week before the Fed or even after the Fed. That to me is what could help them, honestly. Let's see. Yeah, the jump the gun anxiety we mentioned. Do those bulls have to be fully shaken out? That's the question I've got. Do we need to see something super ugly for all of the late buyers that came in after maybe this high was exceeded and really have bought at very high levels? Do we need to see that gang, or even part of that group, I should say, further under pressure before this ends? That may be true. I also would continue to advocate that if you're new to Market Rebellion and you happen to be watching the video, please learn the collar as soon as possible. And the final reminder is, again, if the heavy selling persists, keep your rolling discipline knob set at 11, because you already saw how we are in terms of the conditions. The conditions are just they're what often precede rallies. Now, it's unlikely to be instantaneous, but that they're getting close to where you normally see them start to step in some way. So look for the squaring up in front of the Fed and Apple as well, of course. And then look also for the language change fetishists to try to seize the day, because if they get the language change, I think, and Apple gets is passable, right? Well, maybe it's not that great, but they're looking at great things next year. They can explain anything away. We all know that. So if they get some kind of a Powell language change from the Q&A, wherever it comes from, if it does, they'll be all over that. That's what will get trumpeted. And that will be, to me, like, that's the most likely thing to provide cover for them to create, I'm guessing, the rally that they're craving to create, because they've had to take a lot of stock down in the last several weeks of ugliness. And I think there'd be nothing better for them than to want to create some kind of a rally, offload it, and then we'll see from there soon. I think they're going to want to try to do that soon, if possible. World events may not permit it. The Fed may not permit it, may, in fact, worsen the situation. We don't know. Apple, I don't know. It may depend on how much the Fed does their thing as to what, one way or the other, as to what Apple's impact is fully. Because in a different market environment, Apple's impact could be used differently. So tough as it gets, gang, a week like this with Apple, with the Fed, with all the stuff swirling around this world. I really hope that everyone just stays disciplined. And I do also hope that you got something out of this rather long macro measure. But again, with so much happening and trying to provide levels, just wanted to cover all the things I thought were salient. I do hope you get something out of it for this week or some week in the future. As always, I want to thank everyone for tuning in. And I will see you all through the webinars, the updates, cocktail hour, etc. Everyone have a great finish to their weekend and stay disciplined out there.